The financial statements are a comparison of two or several financial periods, balance sheet or statement of the financial position, income statement, cash flow statement and notes, in order to determine the financial health of the company. In most cases, the financial analyst has to comment the financial independence, the financial stability, liquidity, profitability, as well as the value creation achieved by the company. This analysis relies mainly on ratios computations. Actually, the financial strength is at the heart of the head executive concerns because it proves the viability of the company. As shareholders take the ultimate risk, that is to say the bankruptcy risk, i.e. the loss of their initial investment, so the firm's sustainability is essential. In this module, we will firstly show you the income statement balances, ISB, which will enable us to calculate various ratios concerning on one hand the measure of activity and on the other hand the risk analysis. This module is made of 4 chapters to introduce the risk and return analysis and the related ratios and measures, performance indicator ratios analysis, key operating measures, financial risk ratios analysis, and cash flow indicator ratios analysis. At the end of this module, a summary will be presented to you as well as many quizzes to let you test your knowledge. The goal of this module is to know how to get the essential figures for the economic and financial analysis of the company from the income statement, IS, the statement of the financial position, SFP, also called balance sheet, and the cash flow statement, CFS. In the by nature presentation, and in order to comment the operational efficiency of the company, I suggest 9 key indicator ratios to look at in case of a financial analysis, whatever the business model. Other ratios exist, but the study of these will permit you to be sure not to miss the essential. However, to be fully meaningful, these ratios have to be analysed over the 2 or 3 past years and in comparison with the peer companies and over the same period. Here are the 9 key indicator ratios to measure the operational efficiency of a company. Roll over the formula to have a description. The shareholders' concerns is to make sound decisions about the financial policy of the firm, that is to say, to select the appropriate resources among internal equity, cash flow, as regard the current and future dividends policy, new debt or new equity. Before examining which ratios may be relevant to estimate the risk, let's remember that an increase in debt leads to an increase in the financial risk of the company, and then to an increase in the shareholders' risk, i.e. bankruptcy risk. The increase in financial debt provides long-term sources of funds used for the capital expenditures, such as means of production or even short-term needs generated by the WCR. But then, assets must prove to be efficiently managed in order to generate cash, i.e. cash flow, to repay that debt. In order to test your knowledge upon the analysis of the company's risk and return, tools and ratios, I invite you to a little quiz. Shall we? Among non-GAAP measures that may be disclosed in the income statement under IFRS, one can find,
albeit optional, firms may also provide these measures in the IS and the notes of the reference document in order to communicate more efficiently the activity to the financial analysts and investors, who usually use them to evaluate the return on their investment.
A company has a sales turnover of €240,000 VAT included, which means €200,000 VAT excluded, and purchases of €180,000 VAT excluded, which means €215,000 VAT included. The stock level for year N-1 is equal to €10,000 as for year N. The publication of a part of its balance sheet is as followed. where the amounts are expressed in thousands of euros. From these figures, calculate the WCR to sales ratio.
The WCR to sales ratio represents the WCR divided by sales, excluding VAT, and then multiplied by 360. Thus, the company has to finance a WCR corresponding to 27 days of sales, VAT excluded.